Welcome back. Andrew Bethel of Bethel Law, where we talk estate planning, finances, real estate, and taxes. Here once again with a Q&A where I answer your questions, with today's theme being taxes, because that's all anyone ever asks me about. But a like and subscription would do wonders for our channel and wouldn't cost either of us a dime. Also, share the video with someone who hates paying taxes as much as you do, and let's get into it. First up is, why should the government even care how much money you give to a relative, and why should you have to pay taxes to a government that gives it away to foreign countries? Now, believe it or not, I hear that a lot. The second one, about giving away all our money to foreign countries, which, go confront your senator and congressman. Foreign aid is relatively small, and these military aid packages are also relatively small, but a whole can of worms on their own, with some funny math on why a subsidy to a domestic company counts as foreign aid. But in all seriousness, let's address the first part about why does the government even care how much money we give to each other? Let's put it this way. If the government didn't care, then rich people would simply give everything they have during their lifetime so that they die owning nothing. What that would do is allow for someone like a Nancy Pelosi or an Elon Musk to transfer all their wealth to someone else, consequence and tax-free, thus meaning the state would miss out on a potential massive revenue stream by letting everyone simply gift each other everything. Let's go further. Aside from something like property taxes, we don't really have a wealth tax, meaning that the government really only taxes transfers of wealth, whether it be buying and selling stocks, a house, or a candy bar. Where there is a transaction, the state, through we as a people, have decided that that's the appropriate venue for taxation. This extends to transfers as a result of death too. Although the overwhelming majority of us won't be subject to an estate tax at either the federal or state level, when your assets pass on to your heirs and beneficiaries when you die, this is a transaction the government has an interest in, and they don't want you avoiding it by giving everything away before you die. In essence, skipping or at least taxing large transfers of money or valuable things is a tool to fight estate tax avoidance. Additionally, it can also be a way to combat money laundering or income tax evasion. As in, buy my cookies, Venmo me the money, but put gift or family in the memo line. Lastly, to an extent, it's also a way to fight or disincentivize people hiding money or assets as a roundabout asset protection strategy. You know, a lawsuit is coming and you give all your stuff away. There will either be a way to unwind that gift, tax it to discourage it from going in the first place, or both. The next question is funny because, yeah, who's going to be throwing around $18,000 to others as a gift and thus have to worry about gift taxes each year? That's a lot of money. Or is it? No, that's a lot of money just to give away because, remember, it's a gift, meaning you're giving something of value without receiving or even expecting to receive something of value in return. It doesn't even have to be the same value, just something of value. Regardless, most of us don't have that kind of cash lying around, let alone enough to just give away. However, the gift tax isn't just on money alone. It's gifts of any kind without expectation of something in return. Did you pay for a friend's vacation? That's a gift. Did you pay for a child's wedding or honeymoon? That's a gift. Did you buy a car and give it to a relative? That's a gift too. Because a gift in the context of gift taxes can mean more than just money, it's possible to inch closer and closer to that yearly tax exemption level without thinking too hard about it. Also, we in the estate planning world use this annual gift tax exemption level in certain circumstances to transfer certain assets during lifetime, like a business, or more commonly, when someone needs to qualify for government assistance for long-term care, and some wealth needs to be moved from their estate in order to allow them to qualify under the rules. Thus, if we think about gift tax limits as giving cash, the dollar amount seems silly. But when thinking about it in a broader context, the numbers begin to make a little bit more sense. I'm not about to give someone $18,000 still, but hey, that's just me. Our last question is on gift tax reporting, and essentially, how do you do the reporting so as not to draw the ire of the IRS? The numbers here are a little out of date. In 2024, you can give up to $18,000 per person per year without paying a gift tax. However, you can also give up to $13.61 million in total during your lifetime without paying a gift tax. Your annual exclusion resets each year. Your lifetime exclusion is the number you can build up to during your lifetime, but once you give up to that amount, you're paying gift taxes on everything thereafter. However, Let's say you give above the yearly exclusion limit to one person in one calendar year, say $20,000. If you give something in excess of the annual gift tax exclusion limit, then you would file a gift tax return with the IRS using Form 709 when you do the taxes for the year in which the gift was given. In our example, you apply $18,000 towards your 2024 annual exclusion and the remaining $2,000 towards your lifetime gift tax exclusion. Thus, you pay nothing in gift taxes and only apply $2,000 towards your $13.61 million lifetime limit, giving you all that extra room to play with. That's it for today's Q&A. I'm attorney Andrew Bethel. Drop a comment below with your questions, like, subscribe, share the video. You know what to do. I'll see you next time.